Thanks, Carrie. Welcome, everyone. We are looking forward to sharing with you today the results of our fourth annual economic assessment and our industry forecast. We shared a little bit of this, just some tidbits at the fall conference last month, but today we really want to dive in and spend some time on a lot more of the metrics and have some time for Q&A as well. So I just want to thank everyone for being with us. And looking forward to the discussion today. I'm going to introduce our panelists, and we have today with us John Gray, who's the principal at Rockport Analytics. John serves as our chief economist here at the ACEC Research Institute, and also Joe Bates, our senior research consultant here at the Institute, who is going to moderate this session. As Carrie said, please feel free to put your questions in, and Joe and I will be tracking those and throwing those out to John throughout the session. But I do want to go ahead and get started because I know John's got a lot of great stuff to cover. So Joe, I'll turn it over to you to get us started.
Thanks so much, Daphne. It's great to be here again with everybody. And I'm really excited that this is the fourth year we've been conducting this assessment and forecast. So as Daphne mentioned, John's going to be giving us a lot of great info today. We're going to be going over several areas. We're going to take a look back and see how we performed in 2022. That's the last full year for which we have complete data. And we'll also look at what the industry means to the U.S. economy. What is the significance of it? Then we'll turn our attention to the forecast. John will unveil our new forecast for the coming 5 years. And he's going to talk a lot about the factors that are driving that forecast, some that are helping to push the forecast up and some that could potentially pull it back a little bit if things don't kind of go the way that he anticipates. So a lot of great discussion here today. And we'll end with a lot of macroeconomic trends as well. So with that, John, I want to have you start us off here with the look back and give us help us understand how things went in 2022.
Sure, Joe. And I'll add my welcome. Thank you all for joining us here today. As Joe stated, the fourth time that we've conducted this analysis. And so we're starting by looking backwards, as we always do before we unveil our forecast. We use a lot of these trends that we're seeing in the industry and the correlation between various different metrics in the global economy and what's happening in engineering and design services to actually build the forecast that we're unveiling today. So just for a little bit of context, we put together this slide that looks at engineering and design services revenue. I'm going to talk a lot about top line revenue today. We also refer to this as economic output. Nominal economic output is economic output that includes inflation. And then we also have some measures that strip out inflation. Inflation is a topic that's front and center on everyone's minds today, and it will be something that we'll cover in detail as we go through some of our analysis and our outlook. But when you look back at engineering and design services revenue, you can see that we obviously had declines in 2009 and then a slight decline in 2010 during the financial crisis and the Great Recession. And then we experienced relatively strong growth from 2010 through 2019. On average, we saw about 4% growth per year in top line revenue over that period. And then, of course, we ran into the buzzsaw that was the COVID-19 pandemic in 2020. You all can see what happened to revenue across the industry then. We declined 6.6%. But notably, when you look at 2021 and 2022, we had a really strong rebound off of that COVID low. We saw 9.7% growth in 2021, and then grew another almost 11% last year to $413 billion in revenue. And just to give you a little bit of context in terms of how that breaks out. So engineering and design services, of course, includes engineering firms' activity as well as the activity of architectural firms. And about 75% of that revenue in 2022 was generated by engineering firms, and roughly a quarter of it by architectural firms, Joe.
Yeah, I think the really important point to make here, John, is that this includes the effects of inflation. And while inflation in 2021 wasn't that high at all, we did start to see it increase in 2022, as most folks remember. So that, you know, some of that revenue is pushed up by inflation, but it's still really, really strong growth in both of those years. So, John, tell us a little bit more about these numbers and sort of break it down here in comparing 2021 to 2022.
Sure, Joe. So yeah, obviously with top line revenue growing at 11% last year, we saw a lot of the key performance indicators that we measure across the industry also up very strong in 2022. You can see jobs. This is the total employment within the industry, up 4.7% last year. That growth rate would have been even higher if it wasn't for some of the labor challenges that we've seen industry-wide. Total establishments, this is essentially the number of engineering and design services offices around the US, up 6.3% last year. The average wage paid across the industry was up 4.6%. This is a little more than double the average rate of growth in wages when we go back and look at historical growth. And we'll talk about this in a few minutes, but we've seen that extend even further as we went into 2023. And then the last two items here, you can see the economic contribution. Obviously, with revenue being up double digits, we saw very strong growth in terms of the economic contribution made by the industry, as well as the tax receipts that are generated through engineering and design services activity.
And those tax receipts, John, I think that's always really important for firms as well as our advocates out there to remember that, you know, we are providing a lot of revenue towards state, local, and federal governments. So, John, I know that there's a lot of things that you've baked into this forecast. So maybe walk us through a little bit, just, you know, briefly, what you're seeing affecting the numbers. And we're going to talk about what affects the forecast going forward a little bit more later.
Yeah, so just wanted to pull out a couple of key themes that we saw as we started analyzing and digging into 2022 in terms of what drove that outperformance, you know, that 11% growth that we saw last year. The first one, the pandemic recovery, talked about the 6.6% decline that we saw in 2020. Obviously, there's somewhat of a cyclical snapback that happens as we go through and recover. And so that is part of the storyline here. But also it's the economic stimulus that went into the economy, right? On the monetary side, we saw rate cuts. We're now seeing aggressive rate rises, which we'll talk about in a few minutes. But coming out of the pandemic, the Federal Reserve was aggressively cutting rates. And there's a lag effect to those rate cuts. And that lagged effect has really continued to push revenue into 2022. We also saw a lot of fiscal stimulus, right? So a lot of dollars from federal and state governments that found their way into households and into firms. For the engineering and design services industry, the infrastructure bill, right? IIJA, a pretty big deal. And so you can see infrastructure investment. We know that the rollout of a lot of these infrastructure dollars have been slower than what we had initially anticipated and what a lot of engineering and design services firms anticipated. But it did help to boost revenues in 2022. Inflation here, Joe, this is one that you mentioned a minute ago. You know, we would be remiss not to include that. You know, it's not really a driver of performance per se, but it is a driver of the overall growth rate that we see. We had about 7 to 8% inflation in 2022. So if you think about that and you strip the 7 or 8% out of that 11% growth, we can think about 3% as being, still a very respectable growth rate, but very different than the 11% top line revenue number that we measured. Technological advancements we've included here. This is more anecdotal. We don't necessarily have a lot of data on exactly what the contribution of technology was to revenue generation in 2022. But we know that there were significant labor shortages. We know there's a lot of emerging technologies that firms are using, like BIM and digital twin, and utilizing AI to help with businesses and with their businesses. But these technologies are in their early innings, but we do think there was a notable contribution in 2022. And then lastly, the performance of key end markets. And Joe, we're going to spend some time here in a few minutes really digging into these end markets, in particular, kind of where we see activity going across these end markets over the next few years. But back in 22, what we saw was residential was still performing very well. We saw commercial real estate also growing at a rapid pace, as well as manufacturing. A lot of the onshoring efforts that we've seen across the U.S. has driven performance in some of those markets. So those are some of the key things that we saw drive those numbers last year, Joe.
Yeah, and I think we'll put a footnote on the sector performance, because it's very different what's driving our forecast going forward compared to the numbers back in 2022. So John, I know you've got a lot of great data here. So let's talk just briefly a little bit more about how important our industry is to the U.S. economy, and again, dig into some of the numbers a little bit.
Sure. So every year when we do this study, we don't just look at revenue generated across the industry, but we also look at the economic contribution that revenue generation makes to the U.S. economy. And there's really three different buckets that we look at when we talk about economic impact or economic contribution. And those are the direct impact. This one is probably the most intuitive to everyone. This is really the impact to the industry itself, so to the engineering and design services firms. So of that $413 billion in revenue, you can see in that column on the right-hand side, $240 billion of that actually stayed with engineering and design services firms. Then we have two other buckets of impact. One is the indirect impact. This is essentially the impact to the supply chain of the engineering and design services industry. And so all of those other sectors, all of those other businesses that help to support that $413 billion in revenue that were generated, think about accounting firms, legal services, supplies, technology. All of those things can be attributed as the indirect impact of the industry. And then lastly, and very notable for the engineering and design services industry, is the induced or income impact. And this is notable because of the higher than average wage that's paid across the industry. So, I think we're a little over $100,000 on average, and that's paid across all roles within engineering and design services in 2022, significantly higher than the average U.S. wage. And those wages that are paid to those workers, a portion of them are saved or invested, but a good portion of them are respent in the U.S. economy on all the goods and services that we all buy every day. And so all told, Joe, when we add all of those things up and model what that means, for every dollar that was spent or that was generated in revenue in 2022, about $1.50 was added to the U.S. economy. So you can see that $627 billion number there.
I think that multiplier is really phenomenal, John, that, by investing in infrastructure in the built environment, we're not just creating the actual thing, that has been produced, but we're adding to the overall economy in so many ways. I think that's just a remarkable story to tell for our industry. And part of what you have in the full report, and the full report is available on the ACEC Research Institute website. We'll have a QR code at the end that you can link to the report. But John, you have a lot of state level detail as well. So I'd like you to share with us a few of the highlights here that you discovered when looking at the state data. And again, so much more of this type of information is available in the report.
Sure, Joe. Yeah, and that's a good point. We've got a limited amount of time here, so we're not going to be able to really do a deep dive into the states. But all of the measures that we have at the national level, we analyze and we look at the state level as well. So talking about top line revenue, talking about the number of jobs supported, talking about the wages that are paid, talking about that tax revenue generation. We look at that across all 50 states. And so you can see here on the left an example that maps out engineering and design services employment. So these are the total number of employees in thousands across the states that we measured in 2022. And as you might expect, this correlates pretty highly with population. Not surprisingly, states like California and Texas, Florida, New York, Pennsylvania lead the way. But there's some interesting insights when we dig into this. When we look kind of on a per capita basis, we see some outperformance in states like Colorado, around Washington, D.C., Virginia, Maryland. And so there are some areas of insight to really be gleaned in terms of where that activity is happening and why. And I think importantly, on the right, we're looking at actual performance across these states last year. And one thing you'll notice as you look at that far right column there is a pretty big difference when we look at some of these top 20 states between the top and what other states are doing. So I talked about 10.9% growth in 2022. You can see the top states on the list: Mississippi, Oklahoma, Wyoming, growing at about 20% or so last year. We've also looked at, these larger states that we continue to see growth, and we box these out, North Carolina, Georgia, Texas, because these are states that we continue to see growth year after year. And you can see not only an impressive growth rate there, but you can see the size of these states as they continue to gain both population as well as generate revenue in engineering and design services. In fact, when we look at Texas, we think Texas is likely to pass, Joe, California over the next few years in terms of being the largest state in terms of revenue for engineering and design services.
Yeah, that's pretty remarkable. And I think this is very helpful for firms who are just doing business in one state or two states. They can look and see how are those states performing and how are they performing relative to the overall. So I think this is really great information to have. Just a reminder, please put in your questions in the Q&A or the chat box, and we will ask those of John. Daphne, I think you have one ready for John.
I do. And before I ask that question, though, I did just want to point out, Joe, I think you sort of touched on it. There's a lot of state level data in this report. So I encourage people to go look at that, especially our state MOs, our member organizations that can go and use this information when they're in their state houses, trying to show the value and the importance of and size of our industry in their particular state. So there's a lot of great charts like John has here, but showing all the states across all the different metrics. So that's a good one to know about. So John, lots of great state level data. What about rolling this up a bit? We sort of started at the national, then we went down to state, but are there regional differences that you're seeing in any of this data?
Yeah, Daph, I mean, we continue to see outperformance, and I think probably a lot of you all on this call today have heard over the last couple of years, or you're doing business and you're focused in the Sun Belt region. Sun Belt, you know, we look at North Carolina, Georgia, Texas. So whether that's the Southeast or Southwest, we continue to see outperformance there. And these are longer term, more secular trends that we see in the Sun Belt. We also see Mountain West continue to be a very strong performer. And so I think a lot of these, again, are really secular trends. And on this next slide, we'll actually get into that a little bit when we look at kind of population growth. This is data that we have from the Census Bureau. We're looking at the last 2 years, so 2021 and 2022, in terms of population declines and population growth. And so on the left-hand side of the slide, you can see these gateway cities. So these very large cities, New York, Los Angeles, Chicago, San Francisco. And what you can see notably here are declines. And in particular, you see declines in 2021, that sort of post-COVID, a lot of people were no longer reporting to the office. They were free to go where they wanted, and they went to lower cost metro areas. I think what's interesting here is the moderation that we see in 2022. So we see a continuation of that trend, but we see it moderate across all of these markets, which tells us that, you know, there probably is a fair amount, not everybody's getting called back to the office, but there are some firms that are starting to call workers back to the office, and we are starting to see a little bit more, call it normalization of these markets and kind of what these markets are going to look like post-COVID. Now, alternatively, on the right-hand side, you can see what's happened in the Sun Belt metros. So we look at Dallas, Houston, Atlanta, Phoenix, and Orlando, and we see an opposite trend in that those markets continue to grow population-wise. So 2021, very strong growth, but even more growth in 2022. And what this tells us is that this is, as I mentioned before, more of a secular trend, something that we think is going to change and shift long-term. It's not temporary. These are going to continue to be very strong markets for AE over the next few years.
So Daphne, it looks like we have another question that's come in. If you want to, do you want to pose that one?
Sure. So before we leave this section, John, you talked a little bit early on about some of the factors that were influencing and impacting the numbers for 2022. The question is, how much do you correlate the rising revenues in these smaller states to IIJA, IRA funding and incentives versus just growth?
Yeah, I mean, Daphne, we haven't really dug into at a macro level what IIJA. The White House has released the funding that's gone into each of these states. So I suspect some of that is IIJA, especially when we look at markets smaller markets that have a little bit more volatility. For example, when you look at New England's markets, you know, Vermont, New Hampshire, really strong growth last year. I talked about, you know, some other markets like Mississippi and Missouri that performed well. And I suspect some of that is IIJA dollars, which is going to have proportionately a bigger impact on these smaller states.
And
so
then,
I know.
oh,
Yeah,
go ahead.
No, go ahead. All right, so I think we've got some more questions coming in, but why don't we go ahead and move to the next section, and we'll keep addressing these questions as we go along, however. So, John, let's get to the big reveal. What's your forecast look like?
Sure, Joe. So this is the fun part where we get to look forward and we get to see, you know, the hard work of our labor here in terms of doing the analysis and projecting where we think the industry is headed. So what you're looking at here is nominal economic output. So again, the numbers represented in these bars include inflation. And so starting with 2023, you can see 7.9% growth in nominal terms is our expectation. So another really strong year for engineering and design services. We've seen us come off of those highs from last year at 10.9%, but we've also seen inflation come in a little bit. So if you look at that real output growth at the bottom, that 7.9% is going to translate to about 3.3% real growth. So as I talked about in 2022, we had a lot more inflation. So in real terms, we were probably slightly below where we're expected to be this year. Now, we do expect things are going to continue to slow, in particular as we move into 2024 and 2025. As we all know, we're in a higher interest rate environment. Necessarily, that's going to take the wind out of the sails of both the U.S. economy, construction activity, and engineering and design services activity. But we do have IIJA. We do have a lot of things that are helping to support some growth. So we do not think that we're going to see declines in revenue or in economic output over the next couple of years. We just expect a slowdown. And then as we start to move out towards the out years, we see a little more normalization, 3.5% in 26, 3.6% in 27, and 3.8% in 28. And you can see there, if you look at the difference between nominal and real output, we obviously expect by that point in time that we've got normalization in inflation as well, Joe.
Okay.
John, I just want to jump in because I feel like each year when we share this information, there's kind of two questions we typically get at this point in the presentation. And one of them has popped up on the screen. And so I'm just going to ask them both. The one that I know we always are trying to figure out how to answer is the influence of federal versus private investment, right? So how much of this is coming from public investment versus private investment as far as the growth? And I know that's something that is challenging to put our hands around, but is there anything you can share with us on that topic? And then the second is, how does this compare to a year ago?
Sure, Daph. So taking the first one, in terms of public versus private, unfortunately, we don't have any specific data that tells us exactly how much of this revenue is public versus how much is private. But what we do know is in 2022 and thus far in 2023, there's been a fair amount, public has outperformed private markets. And I think we'll continue to see that happen as we move into 24 and 25. I know we're going to talk a little bit about end market performance in a few minutes, so I don't want to give anything away there. But certainly, the public sector growth is helping to offset some of the weakness that we're seeing on the private side. And then in terms of the second question, how did we perform versus our expectations from last year? We've actually performed better. When we look at our expectations from last year, we were expecting about 6% growth in 2023. And so you can see here, we're now expecting close to 8% growth. And I think the main reason for that is, if you think about where we were last year, when we were presenting this forecast, we were talking about a pretty high likelihood, or at least a strong chance of a recession. At the very least, we expected a significant economic slowdown this year, and we just haven't seen it. The economy's been really resilient. I'll talk about our macro outlook here in a minute, but that's really supported the growth that we've seen in 2023, and we expect that to push into next year. I mean, the other thing that we've seen industry-wide is a backlog, and I know, Joe, you could probably speak to this. I know the member sentiment study that you conduct quarterly has shown that backlogs continue to be very strong, and that's really continued to support growth, even as things have slowed and interest rates have been on the rise.
Yeah, you're exactly right, John. The industry outlook from the member point of view, the senior executives at firms that we survey, they're reporting continuation of strong backlogs. They expect those backlogs to continue to be strong and grow. So we're seeing a lot of strength from the survey that we conduct on a quarterly basis. You mentioned, John, the sort of the outlook for the economy. And I always like to call this the most anticipated recession in US history because we have been talking about it for so long. Obviously, it has not materialized this year. As you said, we're doing quite well. A lot of economists are now saying we're going to be in a recession next year. So what do you think is going to happen, John?
Well, you're right, Joe. We continue to kick the can down the road, don't we? And so, you can see here, we had 2% growth in 22, and then I talked about 2023. This time last year, we were talking about the potential for a mild recession, or at least an economic slowdown. As I mentioned, that clearly didn't happen. We're expecting 2.4% real growth this year. And that's really been driven by a very resilient consumer, right? Employment has remained very strong. And despite the rising rate environment that we're in, the economy's been growing very strong. And so you're right, we continue to project weakness, as most economists do. So you can see here a little less than 1% growth in 2024. Our base case is for a very mild recession next year, or at least an economic slowdown. And there's naturally a business cycle that we are eventually going to go through. And I think the difficult thing about timing and understanding this recession is all of the stimulus that went into the economy post-COVID, and then all of the stimulus that's being taken away in the form of higher interest rates in that period of time. And so really trying to understand what the net impact and what the timing of that is going to be is very difficult. But as it stands right now, we continue to expect the economy to weaken as we move into next year. But I think the good news for engineering and design services, as we just talked through, we're expecting still about 3% growth in nominal terms next year, even with the slowdown. And I think that is in large part due to the public sector put that is underneath the industry right now in those IIJA dollars. I should also mention, with the strong consumer, state and local tax revenues have been really strong as well. So it's not just the IIJA spending, it's the other public spending, and states' coffers are really full, and that's going to continue to support growth into next year.
And I think, John, a lot of people were wondering, a year ago and even 2 years ago, was the IIJA going to be as effective as we thought? Because will the states have the monies to provide for their portions of the projects? But as you just noted, it sounds like states are doing quite well. Everything has been moving along very well. And we've heard some anecdotal evidence that there might have been some challenges with the rollout of IIJA, but from what I've been seeing in the sentiment study, that has largely been overcome. Is that also sort of your take on it, or have you seen anything different?
Yeah, and I think we're going to get to it here in a minute, Joe, where we start talking about some of these end markets, but certainly want to touch on, and if we actually want to advance there now, I think it's a good segue to your question here and kind of looking at key end markets. So as we think, moving forward about where the opportunities are going to lie, we wanted to sort of break this out by market to market. And the question about public versus private, and your question, Joe, about IIJA. Wanted to pull this in here to show the forecast that we conducted. The Research Institute asked us to go take a look when the bill was actually being proposed and bouncing its way through Congress, to look at IIJA and analyze what the impact would be from a revenue standpoint on the industry. And so I included, a chart from that forecast that shows kind of the lift that we expected to get over a 5 to 6 year period from IIJA. And you can see there $132 billion in aggregate is what we were expecting. Now, I think the rollout has been a little slow. Things are starting to pick up pace a little bit. I think the White House just announced about $400 billion of funding has been at least announced. Now, that doesn't mean that it's actually found its way into engineering and design services firms' revenues as of yet. But things are starting to move a little bit more swiftly than they were in the first 6 months, year of the rollout. But we did a little bit of analysis, and again, we don't have any specific data on the total number of dollars that have found their way to engineering and design services firms. But based on our modeling efforts, we think about $30 billion or so of that $132 billion has made it to firms at this point. And we were expecting, almost double that at this point in time, somewhere in the 50s. So we are running behind, but again, I think the good news when we think about kind of the weakness that we're seeing in other parts, the private end markets in the sector is going to be offset somewhat over the next couple of years. So if we do see this economic slowdown that, as you noted, Joe, we've all been anticipating for a couple of years now, that IIJA funding is going to help to put a floor under the industry, we think.
And there's no indication, at least yet, or at the moment, that funding won't come through, right, John? I mean, if it's been a slower rollout, it has to mean it's going to be a stronger finish, right?
Exactly. And we think, it's the pig working its way through the python here. And we do think that it is going to eventually, like I said, it's starting to break loose. And when we look at most economists expect sort of next year and into 25 to really at this point be sort of peak years in terms of the rollout of those funds.
So, John, you have some information here on vacancy rates. What is that telling us, and how does that affect the forecast?
Yeah, so just digging in a little bit, Joe, to our end market analysis and looking at some private markets here, specifically commercial real estate. We see a lot of shifting trends, and we see a lot of divergence when we dig into commercial, for example. So on the left, vacancy rates, you can see retail at the bottom here, 4.1%. So retail has been performing extremely well and continues to perform well. And the reason for that is the strength of the consumer that we've talked about. So consumer spending has been very strong. So the retail sector has been very strong, and you can see vacancy rates extremely low. On the other side of commercial, when we look at apartment or multifamily, and we look at industrial, for example, both were performing very well and helped to support, when we look back at 2022, these were two big supporters of the activity that we saw in 2022. And things are starting to shift under the surface there a little bit. You can see vacancy rates in both have really ticked up, at the end of 2022 and in particular into 2023. And so a lot of that is due to supply issues, really. A lot of supply has come online for both industrial in the industrial segment as well as in multifamily. But the demand dynamics, the longer term demand dynamics look really good in both of these markets. And so while we do see some weakness there, and we think there will be some weakness over the next couple of years, long run demand is going to be really strong. I mean, if you think about multifamily, for example, there are just a huge number of rent-aged individuals coming into the market over the next few years. And at the same time, housing affordability, we all know where that's gone with prices and interest rates. And so multifamily demand is going to stay strong. Industrial, very strong with, sort of last mile, industrial space. There was just a lot built, and it's going to take a little bit of time to work through. Now, office, on the other hand, you can see at the top here, we think this is more of a long-term shift, right? We know we've talked about this, a lot of work from home, even though people are getting called back from the office in a lot of cases. There's no doubt that there's going to be less demand for office space over the next few years, and in particular as leases continue to roll off. And so there's going to be weakness until supply, the slow growth in supply can catch up with demand. So I think over the next 5-6 years, we can expect to continue to see a lot of weakness in office space. And you can see on the right-hand side, market by market, markets that are really hit hard: San Francisco, San Jose. You think about all the tech layoffs, all that tech employment that really can work from anywhere in a lot of cases. And so there will be winners and losers in this, but overall, office space is going to struggle the most out of all of these commercial real estate segments.
So, John, I was going to use that exact same phrase, winners and losers. It seems pretty clear that obviously the IIJA is going to help certain of these sectors, but just cyclical issues with the economy are going to maybe drag down other areas. So what can you share with us when it comes to all the different end markets? Who are the winners and who are the losers in your forecast? This is looking forward again.
Sure, Joe. So this maps out all of the end markets that we're looking at. And you can see on the vertical axis, we're looking at the expected CAGR, that's the compound annual growth rate. So how fast we expect each of these end markets to grow over the next 4 or 5 years. And then across the horizontal axis, we're looking at size, right? And so how big each of these markets are. So if you look at the top right-hand quadrant here, these are the largest, fastest growing end markets over the next handful of years. So not surprisingly, we see those sort of public markets, those that are tied to infrastructure, power, street and highway, education. And then if you look at the top, those that are growing fast, you see a lot of the same trends. Transportation, expected to grow very fast. Communication, think about all of the communication facilities that are being built. If we look at sewage, waste disposal, water supply, so a lot tied to public markets. So the question before about public market performance, I think it's taken a little while, but we definitely expect over the next few years for that to pick up. And on the private side, you can see we expect more weakness, in particular those segments that are tied, that are more cyclical and tied more directly to the economy, right? And so commercial, we just talked about commercial real estate and some of the struggles, at least in the near term. Manufacturing is one we mentioned. Part of this is just a natural cyclical slowdown. We've seen manufacturing, I don't have the numbers here, but it's close to doubled over the last 2 years in terms of its size. So all of the onshoring efforts have just been huge for the manufacturing end market over the last couple of years. But naturally, we expect that to slow down, especially as the economy begins to slow and we operate in this higher interest rate environment.
So, John, you hit on one of the questions from the audience here. I think that the question was, did you see an uptick in revenue in the Midwest due to increased manufacturing? That was a question from earlier regarding 2022 data. So it sounds like the answer is yes, but you're saying now it's going to be cyclical and we're going to have sort of underperformance in that area going forward.
Yeah, we can expect a little weakness, but it's going to be market to market. And I think this forecast for manufacturing, there may still be a lag, and we may continue to see outperformance at least as we move into next year. And probably we're not going to see a slowdown until we get to the end of our forecast period. Because remember, these growth rates that we're looking at are over a 5-year period. So we're just looking at average growth here, Joe.
So Daphne, do we have any questions that have come in?
Yes, and one question while we're still on this slide, or 2 questions maybe. John, the colors of these bubbles, do they signify anything?
No,
or is it just to differentiate?
No, they're just help to differentiate between the different end markets here.
Okay, so it's really about the size and where they're positioned on the chart.
Exactly. Yeah.
Right. Okay. The other question, actually, Joe, maybe for you, we mentioned briefly the sentiment study earlier, and I'm just curious to talk a little bit about how we ask about sentiment, about markets in the sentiment study, which we just finished the Q4 study. How does this align with what John is now showing us?
Yeah, our alignment is almost perfect, Daphne. We see the hottest sectors in terms of sentiment among the firm executives that are giving us that feedback. We see streets and highways, transportation of all kinds, whether it's roads and bridges or airports, any kind of transportation is doing very well in terms of sentiment, both current and looking forward. So it's very much in line with what we're seeing here with John's numbers. And also water, wastewater, those are also sectors that sentiment is very, very strong and continues to look positive in the future, as well as communication. One of the things that's not, we break it out a little differently in the sentiment study, but we also see data centers are doing quite well and are, have been, if you live around Northern Virginia, you know that for sure. It's the capital of the data centers of the world. So the sentiment study, I think, is right in line with what we're seeing from John's numbers as well.
Yeah, and a lot of that obviously tied to IIJA. And to your point about data centers, they're getting ready to build one right down the street from me. So there's lots of uproar in the town over that.
Any other questions, Daphne, before we move on to the next section?
So there is one other question. How much of the growth from last year, John, was driven by small and mid-sized firms? Are you able to break out that growth by size of firm?
Yeah, unfortunately, we don't have that segmentation, Daphne. So we just have, total industry revenue data.
Okay.
So I don't know if Joe, if you have any measurements, or any anecdotes from the sentiment survey that might help answer that.
Yeah, we don't track revenue by company size, by firm size, but we do look at sentiment by firm size. And what we tend to see is that larger firms are almost always more positive in their current sentiment and about their firm finances, and smaller firms are less positive. Not that they're not positive, but they're just less so. So I can't tell you how much of the growth is coming from different size companies, but we do know just sentiment wise, it's always a bit stronger with those large firms. The other thing I think is important to point out is that 75–80% of firms in the industry are small firms. So, regardless of how much growth specifically is coming from large and small firms, you have to have significant growth from that 80% of firms to help grow the entire pie.
Absolutely.
And John, just one more point on this chart. Is this reflective of 5 years, this forecast on the different markets?
This is through 2027, Daphne, so over the next 4 years.
Okay, thank you.
Well, John, I know we've got about 10 more minutes here, but we got a lot more information to run through here in terms of what is affecting the economy, what's affecting the outlook. So let's start to dive into some of the macroeconomic trends that are affecting our industry here.
Yeah, so wanted to pull out some key things, in particular that are impacting our outlook, and maybe not even our overall outlook, but various different aspects of engineering and design services and things that are probably very relatable to you all that are on the webinar here today. I want to start just briefly and look at global supply chains, because this was something that we talked about ad nauseum for probably 2 years, right? In terms of what was happening with supply chains. And we've more or less stopped talking about it, and for good reason, as you can see in these charts here, right? The one on the left shows the global supply chain pressure index. You can see that spike that we saw through 21, 22, and you can see the heavy decline that we've seen in late 2022 and into 2023. And likewise, on the right, you can see what's happened to the prices of construction materials that we were talking about last year and the year before. That was a big topic when we were working through our outlook. And those have come back in line big time, as you can see. Actually, we see price declines here in 2023 when we look at construction materials. So just wanted to include this because it's something to think about, as this was a major headwind when we think about construction activity over the last couple of years, and that's one headwind that really has diminished over the last year or so.
Yeah, I was really curious, John, to see that we've had some price declines. That things obviously went up so fast and were increasing so quickly over a couple-year period. I was curious to see if we would actually see some price decline. So I think that's got to be some great and welcome news to folks in the industry. John, talk to us a little bit about rates. That is front and center right now, I think. So what's your take on the current rate environment?
Yeah, and Joe, I think this is probably the most important thing if we had to boil down one factor in terms of where we think the economy is headed and where we think the industry is headed over the next couple of years. It's what happens with inflation and then of course what the Federal Reserve's reaction is to that in terms of rising or cutting potentially interest rates. And so this chart on the left we put together because I think it really highlights the aggressiveness of this rate increase that we've seen over the last year and a half. So you can see the line 2022 and 2023, that's our current rate hike cycle. And how high up that line is on the vertical axis is how much of a rate hike we've seen. So 525 basis points. And the horizontal axis shows us the time that rate increase has occurred. And so you can see that line is on a relative basis pretty much straight up, right? So we've had this very aggressive increase in rates. These other increases represent every other major tightening cycle that we've seen over the past 40 years. And so what we have is really unprecedented in terms of the rate increases. As we all know, the Federal Reserve was way behind with these increases. They thought that inflation was transitory and we can continue to leave rates low, and clearly that wasn't the case. And so the lagged impact has been a tremendous amount of inflation, as you can see in the chart on the right. We've actually broken this out. So this is core inflation, which strips out more volatile food and energy prices. And we look at core inflation because that helps to tune that noise out of this. We can really understand where prices are actually headed in the economy. And I wanted to take that a step further here and strip out goods inflation from services inflation, because I think this tells another story. When you look at the orange line, that's goods. And you think about what we just looked at with supply chain factors, and the notion that these price increases were transitory, as the Fed thought. They were transitory on the goods side of the economy. It was supply chain driven, and we've seen that come back in line. So when we look at the last two readings on inflation, we're down to zero. There's essentially no price growth on the goods side of the economy. But where we see a lot of stickiness still is on the services side of the economy. So you can see there 5.5%. You can see the blue line, services inflation peaked about a year after goods inflation did. But the good news is it is coming down. You can see it's very clear that these rate increases are working. Inflation is heading south. In fact, we got October's reading just yesterday, Joe, and came in lower than expected, significantly lower than expected. And so this is really good news in terms of, the Fed being able to potentially navigate this soft landing, but we still have a ways to go to get down to that 2% target where the Federal Reserve wants to be.
So John, in your crystal ball, which I know all economists have, do you think
I just polished it this morning, Daphne?
Very good. Do you think the Fed's going to stop raising rates anytime soon? How long?
Yeah, that's the $1 million question, right? Because it's whether the Fed raises rates or not, is really what's going to drive the economy over the next few years. I think these last two readings we've had are really positive. So if you look at the prediction markets, if you look at what they're saying about where rates are headed over the next year, pretty much universally, we think that rate increases are done. right? Especially after yesterday, the probability went way down. And so I think more than likely, unless we see something, some major change that no one's expecting, the Federal Reserve is likely done. Now, I think we still need to think about these rates being elevated for a longer period of time, because we're still at 4%. And there's a lot of stickiness in this. We'll talk about wages in a minute, but wages are a big part of what's driving this. And I don't think we're going to see that, we're going to see wage growth come back to earth as quickly as we've seen, certainly the goods side of the economy or even other parts of services. So, there are many economists that are now saying that we might see some pretty aggressive rate cuts next year. I think the market is expecting some rate cuts, as we get later into the year next year. But I don't think we're going to see those aggressive rate cuts unless we see significant deterioration in the economy, which none of us really want to see. So if we do see big rate cuts, they're going to come because, we've seen bigger cracks in consumption and business spending and a lot of the other measures. And the Federal Reserve is worried about shoring some of those things up.
So, John, I know we only have a few minutes left, but you just hit on a key term, wage inflation, and that's not measured really in any of these other metrics. So what is happening with wages that you're seeing? From the sentiment study we conducted last January, we were getting reports of an average of 10% year over year wage growth at member firms. So what is your data showing us?
Yeah, Joe, and I know this is an issue that hits close to home. Every time I have a conversation with one of ACEC's member firms, this is something that comes up, right? It's the challenges of finding labor and the cost of labor right now. And you can see, as you measure in your sentiment survey, we're seeing a lot of the same trends in the economic data. If you look at the chart on the left-hand side, we're comparing, this is wage growth in the US, the blue line, compared to engineering and design services wage growth, the orange line. And so I talked about early on when we were reviewing 2022, the fact that we saw 4.6%, the average wage rise by 4.6% in the industry last year. When we look at Q1 of 2023, which is the first period, or the last period rather, that we have data for, we can see on a year-over-year basis that has jumped to nearly 10%. So we're at that 9.7% that you were seeing in your sentiment study, Joe, right around double digits there. And so that the growth has been just incredible. And I think the chart on the right helps to highlight some of the supply and demand dynamics that have driven wages in the industry. And so this is data from the BLS that looks at professional services, hires, and job openings. So the lighter kind of beigeish colored line is job openings, and the dark blue line is hires. And so you can see in a more normal economy, these two move pretty much in lockstep, right? There's a job opening, and then the firm fills that opening with a hire. But post-COVID, due to both supply and demand impacts, right? We had from the demand side, all of this stimulus, the industry performing very, very well. And that was pushing demand for workers. On the supply side, we saw a lot of people leave the labor force, right? And so that drove up the number of job openings relative to hires. So you can see back in April 2022, when this was at its widest gap, there were 1.8 job openings for every new hire. Now, the good news that we see here is that when you follow this all the way out to sort of mid-2023, that's come back in line, and we're at 1.2 openings per new hire. So we are making progress on this front.
That's really good news, John. I know another metric I track very closely is the labor force participation rate, and that has finally started to inch up a little bit the last few months. And that's why you're actually seeing an increase in the number of unemployed people while we're still creating jobs, and that's good news. So I know we're just about out of time, John. I'm going to just throw up here the key takeaways for folks. I think, obviously, if they've been listening intently, which I know I have to you, all of these is just summarizing what you've already said. We've answered all the questions that we've gotten in today. So thank you all for the questions. And Daphne, I just want to throw it back to you to close us out.
Sure. I wanted to throw up, Joe, thank you. If you could go back to that QR code, just give people a few seconds in case they want to download the study. This is the QR code to do that, so you can get the full report. As we talked about, there's a lot more data in there, a lot of state level data, end market data, et cetera. So I encourage you to grab that. You can always just go to the ACEC Research Institute website and get it as well. And we do have another session coming up in a couple of weeks on the sentiment study, which we've referenced a little bit, but the Q4 sentiment study, we're going to dive into that with Joe as well, and you can register for that on our website. And then finally, I just want to close out by thanking all of our sponsors. We obviously could not do any of this without them. And so these firms here and organizations, foundations have been very generous in supporting the Institute. And we just want to give them a big shout out for making this research possible. If your name's not on here and you'd like it to be, please reach out to me. I'd love to have a conversation with you about joining the ACEC Research Institute family. And with that, I think we will close out. Thank you very much for joining us, and we look forward to seeing you next time on a Future of Engineering Roundtable. Have a great day, everyone, and be well.
Bye.
Thanks all.